was a little bit more quiet, normal week. Some economic data and some stuff out of China. So I'll have a shorter one than normal this week, but we'll go through the week. I do think you'll keep hearing me talk about inflation just because in a world where I don't think we have recessions, when you start to hear worries about recessions, that's usually a good time for the market as soon as the sentiment gets there, just because that normally means inflation's on the lower side. But I think as soon as inflation starts to bounce, given the fact that I think we're going to stay at a higher regime, people have to get used to what will scare people more than normal. And I think any fear of inflation, given the fact that we're above where we've been in the past and we're kind of worried about the certainty over the Fed, if they're going to pause or possibly hike, I think that's where the negative stuff will come in. We're getting close to the earnings period, so that'll become a story this week, and I'll go through China. So I'll try to get through these things fairly quickly. Just moving on, right about the S&P made new all-time highs. It was up for the fifth week in a row. So again, no signs in the equity market of stopping at this point. The most important breakout to me and what we're starting to see is a little bit more from the small and mid caps, but this week it was a breakout for the mid cap ETF, the IWR. So you finally got a strong performance. This is the daily move breakout on Friday. I think that's a healthy sign. NVIDIA got back to all-time highs again, and this is overlaid with the Goldman Sachs AI winners versus loser basket. The fact that it has taken out the August highs at the same time that NVIDIA got back up there, and you can see that now we're starting to get a little more recognition on NVIDIA probably not being done anytime soon. And as long as NVIDIA is able to generate earnings or get hope on their new GPUs in terms of the Blackwells, it will help the equity market. I don't think you're going to get as much enthusiasm. I think we've seen the peak in AI, but any help from the tech side is going to help a broadening out on the fact that the Fed's cut rates, you've got lower rates, and that China's doing stimulus. 10-year rates continued their move higher. It's not a sharp move higher. You've obviously taken the yield curve back. Everything's around 4% now. So we've got kind of a flattish yield curve, and expectations are starting to drop. We've got 46 basis points. This is the December meeting Fed funds implied rate cuts by then. So we've got 46 basis points now built in. So it's given up where, after the Fed cut, we were at around 75 basis points. Now we've given up a bunch of that. So market's just building in as the economic data has been better and as the inflation stuff has been higher, the less likely that the Fed cuts. But I do want to say there's still plenty of rate cuts built into the Fed curve. So we'll see if that gets taken out. I think it's going to take some inflation data to come higher because I do think the economy is fine. But I don't see any chance of any kind of big acceleration. We finally got a down week in commodities. This is the BCOM, Bloomberg Commodity Index. As China saw some, let's say, mean reversion, you saw commodities come down. Probably the most important news of the week, and just again, this has been going on for some time, but it is just the continued strength in the credit market. This is the IG option adjusted spread. We closed the week at 81 basis points. The low is 76 basis points back in '05. There's absolutely no sign of any problem with inside the credit markets. Junk spreads continue to come down. Even taking a step further, the worst part of junk. So this is the triple C total return relative to the high yield total return. It's been going straight up since August as we started building in more rate cuts, or any rate cuts, to be honest with you. In terms of the starting point, you started to see strength in credit. And the reason this matters is without credit widening, this is going back to 1980. This is the BAAs relative to 10-year rates. And you can see that during recessions, we've had spreads widening generally for a period of time for the most part. So again, we just don't have any signs right now within the credit markets. What we did have this week is this is the MOVE index, which is the white line, which is basically Treasury vol. You've got the VIX, which is the equity vol, and then you've got spread. So We did have a little break in correlation, and the reason I wanted to bring this up is because going into the election, there has been protection that's been put on, and I think that that'll keep a bid under the market as we go through the election. But just keep it in the back of your mind because the seasonality starts to kick in the third week of October. I do think if you see vol come down, you have to remember that we had this spike in vol during the summertime, realized vol, and that definitely took the systematic strategies that are vol targeted down. And I do think that you're going to see an underlying bid to the market that comes in November and December unless something changes on the inflation front or the earnings front. Just an area that you may want to focus on. I showed how the mid caps had done. This is credit spreads going back over the last 15 years relative to small cap over large cap and equal weight over the S&P. So this is actually these are the inverse. So this is large cap over small cap, large cap over equal weight. We've heard about this all year, how poorly these things have performed. They've performed poorly on a relative basis. They've actually done fine now in terms of year over year, but this is not normal. So with credit spreads this tight, normally you're seeing some beta risk taking moving out. That has not started yet. But I do think going forward, that's the area that you want to watch for both a signal of broadening out, but also if China's successful and you get a bounce in the ISM, normally these things do well. Since I think you will see an ISM bounce into Q4 or during Q4 into Q1, I would expect that small caps and equal weight will outperform at least somewhat, and we'll get some kind of movement back this direction. The reason I mentioned that it's actually been better than what people think. Ed Yardeni put this out this week. Just the percent of S&P 500 companies with positive year-over-year price change, we're now approaching 90%. So that just means that there are a lot of companies, almost 90% of them are up year-over-year. So you've had some sort of broadening out. It hasn't filtered in yet to the equal weight and to the small cap, but I do think that's likely. In terms of economic data for the week, claims. So claims, this is the 4-week average. You had a bigger jump in terms of the weekly number. It was definitely impacted by the hurricane. It was also impacted by some auto changes in Michigan. So you did have a move higher. That's the highest move since 23. What you'll hear from me as I do more of these, I never try to ignore any kind of data change. Even though the hurricane had an impact and even though Michigan had an impact, these are by state. And what you can see is that the change for the week, there's a lot of breadth to it. So it's something worth watching. It's only 1 week. The reason I use continuing claims and the reason I use 4-week average is because this stuff is noisy, particularly around hurricanes. Hurricanes or any kind of holidays. The one thing that should be known is because of hurricane, in Florida this week, you're going to have a lot of data that you should expect to be almost useless over the course of the next month. The jobs number, the claims numbers, I think it's going to be very, very difficult between now and at least November, depending on how long this takes for everyone to get back to work when the flooding recedes back. But you're going to have some number that's going to be distorted, and that's going to make it more difficult. So I think that helps the stock market in one way. I don't think the data itself is going to be enough in terms of the jobs number to change people's views or the Feds in terms of making big moves. I would expect it to be surprisingly weak. Just because of the size of the impact in terms of 3+ million people down in that area, but it also went across Orlando. It's a big populated area, so it wouldn't be surprising to see data that's just not useful. In terms of GDP now, we're still sitting around 3%. So again, everyone kind of even still sending out stuff about recessions are coming. You really can't pay attention to this stuff. There's just no signs of it whatsoever on the equity market, on the credit markets, and here you can always find a few data points if you want to be negative, but there's nothing going on. A report that came out this week, and just for people who keep wondering how everything is so stable and how we're not having a recession, I just want to make sure that people kind of go through. So what I did is I took the report. This is the title of it if you want to go find it. I copied it into ChatGPT and I asked it to give the summary. But you can see down here, the economy is being driven by the high-income households and the middle-income households dramatically. Low-income households from 2018 to 2024 in terms of real spending, you've got this is kind of recessionary type levels to have that over a 6-year period. These numbers are indicative of a GDP, which is more around 2.5% to 3%, which is what we've had. The problem is they are responsible in terms of these groups for over 70% of spending. So you need these people to be in trouble. If you're losing jobs or if people aren't spending much on the low income side, that doesn't drive the economy. And you have household net worth, which has exploded higher. And this is the group that dominates that. And the top 40% own almost all of the household net worth. So that's why I've said before, about 70% of Americans live paycheck to paycheck. And when you're living paycheck to paycheck, you're sensitive to inflation, you're sensitive to insurance costs, you're sensitive to all the things that have been happening. But in terms of a recession, that's a much harder bar to set. If stocks are making new all-time highs, then the people that are talking about the ism, it's just not a relevant thing to be looking at the way it has in the past because of the wealth distribution. The most important data point for the week was obviously the inflation data, and I've talked about this. I'm going to continue to talk about the fact that I fully expect that inflation is just different, and this is the core CPI, which came in at 0.31. I showed this last month. Two things about it. The trend is higher. We've been moving higher. The second thing is the last two data points were both 0.3. You can go back in the decade before we printed an insane amount of money. You only had one, two, three reports that were as high as the last two. So that's the way that I like to look at data. We've obviously had a normalization in inflation, yet we're still getting these big prints. This is the super core, which came in at 0.4. Again, the trend is higher right now, and it seems to be settling around that area. If you want to go through and look at the contributions, the main contributions are on the medical care services, transportation services, but you can look at each of the ones there. There's just a breadth on the core side that is sticking up. I've shown this chart many times. This is going back to 1970. I like to use the white line here, which is the sticky X shelter. So this is core Fed sticky 12-month annualized. So it's up at 4%. CPI core had a bounce back to 3.3. I believe this one is a better one to use, which is tracking higher. And so I think the sticky part of core is up there, and the part that's a little bit more flexible, which gets into commodities and goods, I think that's going to start trending higher. Because we've been sitting down at lower levels. Secondly, because interest rates have come down and we've seen some unfreezing of the housing market, which even if we have an uptick in inflation, I don't expect the Fed to hike, which would mean that we're going to be sitting with the housing market having a little bit more activity, and that'll be good for the goods side. The other reason I think the inflation stuff has to be built in is something that I've talked about as well. The Council of Economic Advisors put this out, but it just showed headline inflation came down in the 2% area, but the stickier stuff, the wages, they're showing the same thing I've shown, which is wages are still sitting around 4%. So you've got wages above headline. That's going to keep headline from coming down. So the question is, have we seen the best of the inflation data? Here's more breadth on the wage data. I've shown this before, but again, you've got the average hourly earnings is the white line. You have the ECI, which is here, so the employment cost index, and then you have the Atlanta Fed median wage. So these are all between 4 and 4.5. And here you have core CPI, which has tracked it, and it's pointed back up. So I think we're going to head back into this 3.5 to 4% area. I don't think the Fed is going to hike unless there's some data that comes out even higher. And the only way, in my opinion, that will happen is if this starts or continues, which is the white line here is 2-year break evens on tips. They've moved higher by 60 basis points since the Fed cut rates. Remember, tips break evens on 2-year rates actually peaked in front of the actual CPI peaking. And now you've got this having a bounce, not very similar to the bounce we had here. Just remember, during this bounce here, you had a negative, this is when people thought inflation was going to be much more of an issue. So you've got a bounce here. So I just think people need to pay attention to what's happening on the inflation side. I've highlighted this before. The orange line here is gas. This is now CPI over it. Don't underestimate, and I would watch gas. I had shown that the unleaded gas futures were implying below $3. Once we got a $5 to $7 move higher on with risk premium in crude from Iran, fears We have moved unleaded gas futures back up, so they're no longer implying below 3. So we're about fair level now, so we'll have to watch oil. But I do think there's a risk that if China actually does have some success and you see commodities start to have a trend higher, that you'll at least see a bounce in this. If we do see a bounce, it's going to come at a time where CPI again will probably move higher. I just want to make sure these are charts that I haven't shown since a couple years now, but I highlighted this chart. This is a chart back from I guess I did this in 22 when we were trying to find a bottom in the stock market, and I had made the point that if you use the 70s as a gauge, the second that CPI peaks, that's usually a point that you want to be in the stock market. So this was the peak in up at 12% in CPI. The stock market had bottomed about a month before, a couple months before, and then it went on a trend that lasted basically until we had a bottom in CPI. I highlight this area there because any kind of uptick in inflation, even for a short amount of time, it tends to lead to an overreaction in the market. And I remember this from Brazil. When I lived in Brazil, I was there just after the hyperinflation period. And whenever inflation had any kind of uptick, even for a month, it would scare investors and you'd start to get people uncertain because 2 months or 3 months of it in a row would bring back the PTSD from what was happening in the market back then. And I do think we're going to see parts of that. Now, this is the 22 period. So again, very similar. You had the peak in inflation here. This wasn't the bottom. We made a slight new bottom, but you can see that as inflation has come down, you wanted to be in the equity market despite people's fears of a recession, which were dominant back then because of how quickly the Fed had raised rates. They were still raising rates in here. So now we're at all-time highs and inflation's down here. So if we see the CPI start to head higher, remember, we had a slight uptick here that I showed that led to this little period of weakness in the equity market. I just think you have to be wary right now of this because unlike back here where we were still printing a lot of jobs and the unemployment rate was going down as inflation expectations were going higher, it wasn't bad to have a slight bounce back in inflation because the bigger fear was recession. We had rate cuts built in. Well, we have rate cuts built in right now, but this time we also have the jobless rate, which has gone higher. So if we have inflation going higher starting now and fears that the Fed won't ease anymore, I think the reaction will be different. And that's why I think an inflationary, as I said last week, boom makes more sense to me, where you want to be in commodities and you want to be in things that are maybe a little bit more interest rate sensitive. I just want to bring this up. I'll move this camera over for a second. Just this Fidelity posted this on Twitter this week. Earnings estimates. I just want to highlight two things. One is, again, even in earnings estimates, there's no signs of recessionary stuff in there. We do have revisions that people are talking about down 1%. This is not abnormal. This is all the times over history. We've got 12% year over year earnings growth, which is built in, which again is a good number at this point. So I would not be worried as we enter earnings season here for anything big. One thing to just keep in mind is that obviously we've been dominated over the course of 23 and into 24 by the Mag 7. Their earnings have been just fantastic while the rest of the market have not. Well, for EPS year over year, we're starting to get a point that if this actually happens in terms of we start to see a bottoming and some kind of increase in the S&P 500 X to Mag 7, another reason to expect maybe small cap and mid cap will outperform. And then finally, just from how this typically does in the first 4 weeks of reporting, you usually get the S&P going higher. We do have the election coming in, so I think that's going to dominate. But I just keep it in mind that normally you are getting a bid to the market. Final few charts, just an update on China. It was a wild week. Which should not be surprising because we had a massive rally over the prior 2 weeks. They reopened. There was an announcement on the fiscal side, a completely disappointed. So you've got all these stories about problems. Then they did the press conference was a disaster. I think China is having trouble figuring out how to deal with this stuff. Obviously, in the U.S. and Europe, we're willing to go out there and say, we won't allow the market to go down. I think China is trying to prevent the types of rally they saw last week, but still put a floor under things. And that's why I think this is a game for them that they haven't played before, of trying to turn animal spirits and not create what normally happens whenever you do that, which is if there is a put in China and the government says we'll stop anything from going down and we want it to go up. Well, when you do 30, 40% in 2 weeks, you can extrapolate that number. They don't want that. So I think they're going to keep coming out with measures and figure out some kind of cadence that makes more sense. For the people that are just perma bearish on it, they're not going to turn and change their views. And to be honest with you, I wouldn't be reading people that only write one direction. This may work, it may not work, but your job is to try and make money. And sitting there getting into some numbers based thing that, well, this won't work because they have too big of a problem. That's just not the way it works in this day and age of printing presses. If they want their stock market to go up 30% a week, they can do that. They have enough money to do that. They don't want to do it, but if they want to, they can. This last news piece here is what they did today. This is Saturday when I'm taping this. They did have another press conference, more fiscal measures. You can read the details on this if you want, but they were really trying to be a little bit more specific on what they're going to do. Again, they're not giving out specific numbers because they don't want to, and I don't think they're going to. What I will say is, again, I highlighted this last week. I'm looking for changes where they realize, okay, we have to do something. And last week it was, okay, we want to have more housing transactions. We want house prices to stop going down. So get rid of all qualification limits and things along those lines on mortgage applications. Well, here's another one, assisting with the mitigation of hidden debt. I just think the government is trying whatever they can at this point to stabilize things. What you want to see is what we actually did see last week. We had massive rallies in the local market of, close to 16%. Then the following week 7, and then they gave back 3 and change for this week. That's the kind of thing that you want to see volatility now go down. You can see in the beginning part of 24, there was some stabilization and some positive stuff going on before it failed. It wouldn't be surprising to see something along these lines, and that's why I don't know whether this will turn into something bigger. If you ask me, I think that they're changing their attitude and they want to stop things from going down. So I think they'll be successful. But I do think you want to keep looking. Just at this point, you need to look week to week. And I think eventually they want to get to the point where day-to-day numbers matter more. This is the Chi-Next. I tweeted about this week. This is their innovation index. I used to use this back all the way as far as 15, but I think it's more important now because they did have a significant rally in their semiconductor side. The government has specifically said they want the innovation stuff to rally, and that obviously matters a lot for Alibaba, for Tencent, for things that foreign investors will invest in. But the Chi-Next was only down 3 and change percent after back-to-back 15+% weeks, with one of them being 22. That's a very good sign. I would watch the tech sector there. And for the Hang Seng, it was down 6%, but that was after back-to-back 10% things. So that's it for me for this week. A little bit more quiet week. I'll see you again next week.